Welcome, everyone. Thank you so much for coming to this month's UPotential webinar, in which I'll be addressing questions that have been submitted by the audience. Just a couple of housekeeping items before we begin. The webinar will be recorded and it'll be made available on the UPotential website. A link will be shared with you in an email that you're going to get after the webinar. And as always, please, you're encouraged to send in your thoughts and questions or suggestions for future webinars as well. For those of you who might be new to UPotential, my name is Monique Madan, and I'm a certified financial planning professional, a financial management advisor, and a chartered financial divorce specialist. I started my career working in tax effective charitable giving at the Hospital for Sick Children Foundation in Toronto. And then I proceeded to the investment arm of the Royal Bank, where I worked with high net worth clients. Before going into private practice, I spent a number of years working with Ontario's most vulnerable people, working at the Ministry of the Attorney General's office. So I think you can say that my background is pretty broad. Throughout the various aspects of my career, I have found that the people who can benefit most from our work together are those who are typically at a crossroads with regards to specific and significant decisions that they need to make. A lot of those decisions are what have inspired some of the questions that we're going to be fielding today, and I think you're going to find that they're also incredibly broad in nature. Professionally speaking, I'm the head of financial life strategies at UPotential and ETF Capital Management. UPotential is a fee-for-service financial planning firm, meaning that we offer unbiased advice and strategies to our clients. I'm also grateful to be able to provide my services to the clients of ETF Capital Management at no cost as part of their suite of financial services. The service is exactly the same. It's unbiased advice on the financial strategies that you need, including retirement planning, tax planning, and so on. Thanks again to everybody who submitted questions for today's webinar. You will not believe the variety of questions that came in. I've selected a few to address today on topics ranging from retirement planning and taxes to transferring wealth to the next generation. As you may have also heard, the Liberal government dropped their first budget in 2 years yesterday, and I hope to highlight some of the major talking points at the end of the webinar as well. Now, you should know that questions for this webinar came up as recently as 3 hours ago, and if there's time at the end, I will do my best to answer them. But if I can't, we will be collecting these questions, and don't be surprised if they inspire webinars in the future. So without further ado, let's look at the first question that was submitted. Can you describe how you go about establishing an investment plan, how clients can evaluate your advice based on past market performance, and how often you check in to adjust the plan? This question is really important because as a profession, and like many professions, the financial services industry has a broad share, more than their share of vernacular and accreditations that seem subtle to, the outside observer. As I mentioned in the introduction, I'm a fee-for-service financial planner, which means that I don't sell investment products or insurance. That being said, investing certainly is a central part of any financial plan because most people need to accumulate wealth in order to replace their employment earnings. And the vast majority of us could not possibly accumulate enough simply by saving. Investing is necessary in order to grow the assets that we will then use and tap into when our incomes drop. However, as a fee-for-service planner, when I comment on investments, I have a couple of very specific purposes in mind. In the fee-for-service world, we review investment portfolios really to determine a couple of major things. First, whether your asset allocation, which is the mix of cash, fixed income, and equities, for those of you unfamiliar with the term equity, an equity is a stock or a mutual fund that holds it. We want to make sure that this mix of these three, what are called asset classes, matches your risk tolerance. And secondly, sort of as a layered effect on top of that, we want to make sure that the items are placed in the right places for optimal tax efficiency. So let's first focus in on asset allocation. Research has shown that about 92% of long-term investment portfolio performance has to do with asset allocation. In other words, even when markets appear to be in free fall, as they were about a year ago, if you have a diversified portfolio holding cash, fixed income, and equities, there's likely defensive positions in that portfolio that will help to buoy the portfolio's value during that time. Now, oftentimes these defensive type positions, are stocks or mutual funds that aren't vulnerable to market trends. Or if you don't have those pieces, you might instead have GICs or bonds whose GICs don't fluctuate in value at all, and bonds tend to fluctuate in value related to interest rates rather than broad market pressures. So if we're looking at it from that perspective, that alone is something that a fee-for-service planner would be looking at, looking for that diversified perspective. On a second note, if we were looking for that diversification, in a purely fixed income portfolio would also have, had its lumps over these last many years because of low interest rate environment. So a diversified portfolio holding cash, fixed income, and equities would have seen growth in the equity allocation when the fixed income position would have suffered. So essentially, despite the fact that, if you were largely a fixed income investor, and fixed income holdings have largely fallen out of favor, you would have still seen some defense in the position based on the equity allocation. Now, the good news about all this when it comes to the fee-for-service vision of investment planning is that if you're setting up a portfolio relatively early in life and then you rebalance it periodically, time should allow you the luxury of investing within your comfort level. The problem becomes when we're scrambling later in life in your pre-retirement years to accumulate or make up for lost time, a few years before you need the money. If you're in that type of situation, very often you could be forced to take on more risk than you can really stomach. So that's all the more reason to start investing early and consistently. Now, turning our attention to the tax efficiency of the portfolio, the primary concern is usually where certain pieces are placed. And this can have an enormous impact on your after-tax return on investments. So for example, if you were to have a portfolio like the one in this diagram here that might have a 35% fixed income allocation, ideally, that fixed income, because it has no tax efficiency, should be placed in your RSP. You see, whether your RSP or RIF withdrawal later on in life is comprised of your original contribution or interest, dividends, or capital gains that were produced inside the account, it's all taxed exactly the same way. It's taxed as income. And by that, I mean exactly equivalent to, let's say, your employment income. That isn't to say that you shouldn't have equities in your RSP or that you can't have equities in your RSP. It's just to say that if you're building a portfolio, and a diversified one at that, one that holds, let's say, 35% fixed income, it would be great if that piece were in your RSP and then you build the rest of the portfolio around it. Speaking of equities, by the way, the best place to hold those is in your tax-free savings account because the dividends and capital gains can compound without any immediate or even eventual tax consequences. Now, you may recall if you listened to my last webinar that I addressed this issue of dividends contributing to the clawback of OAS. because they are inflated when you report them on your tax return. So if you're at risk of losing some of your OAS, it certainly could be worthwhile to consider moving these positions into your tax-free savings account, where any income produced in that account has no impact on your old age security. Now, the only drawback here is that, of course, tax-free savings accounts haven't been around long enough to really absorb a large equity portfolio. But I think you're going to be surprised that over time, tax-free savings accounts are going to be really an incredibly important feature of a diversified portfolio. So thank you so much to the person who submitted this question. Next question. I will be turning 65 in early 2022, and I'm trying to decide when to take my Canada Pension Plan and Old Age Security. A close friend opted to take her CPP at age 60, and I wonder if I made a mistake waiting until now. What factors should I consider when making this decision for myself? I have to tell you, I probably field this question in various forms at least once a week. And I think partly it's because when we're working, we don't really pay a lot of attention to the Canada Pension Plan, and we probably don't give a lot of thought to this, what could be a very important decision with respect to when to initiate the payments. Before I give you some things to think about, let me just remind you of how deciding when to take your CPP will affect how much you will collect. And by the way, for this discussion, I will be using the terms Canada Pension Plan and Quebec Pension Plan interchangeably. So as you may be aware, age 65 is the default age for collecting your Canada Pension Plan. You can elect to start collecting it as early as age 60, but kind of as with all pensions, if you collect it early, then it's going to be actuarially reduced because you're likely to collect it for more years. Similarly, if you choose to collect your CPP later, the monthly pension is actuarially enhanced to reflect the fact that you might be collecting it for fewer years. Most Canadians appear to subscribe to the bird in the hand school of thought, since an overwhelming majority of us initiate our CPP before age 65. Research performed by the National Institute of Aging showed that only 5% of Canadians elect to defer their CPP beyond age 65, with only 1% collecting it at age 70, despite the fact that you can really have a tremendous increase in your permanent pension by deferring the pension onset date. Now, of course, none of us know exactly how long we're going to be collecting CPP for, so there are other factors to consider. If you have a family history of serious illness, then it might make sense for you to start taking your CPP early. Similarly, if you have little in accumulated wealth, you may have no choice but to take your CPP either early or at age 65, since it may be one of your primary income sources in retirement. However, if you have accumulated wealth, I would encourage you to give this a little bit more thought, because CPP is an amazing thing. It's a predictable, inflation-adjusted pension that's payable for life with survivor benefits for your spouse. Now, despite the current health crisis, longevity is increasing in Canada, and the Canada Pension Plan is a great antidote for longevity risk. In other words, the risk of potentially outliving your financial resources. To illustrate the strength of deferring your CPP, I've done a little analysis here to determine the total pension collected over one's lifetime based on the age of onset. What I've simulated here is based on someone who would be eligible for the maximum Canada Pension Plan at age 65. And then what I've done in this chart is I've used my professional college called FP Canada's longevity tables, which dictates a life expectancy of 94 years for males and 96 years for females. According to this graph, someone who would be eligible for the maximum Canada Pension Plan at age 65, but initiated at age 60, would collect a total of, what is that there, about $450,000 over the course of their lifetime if they're a male, And the orange line is for females just shy of $500,000 over the course of their lifetimes. These trend lines continue to increase if you initiate your CPP at age 61 or 62. But if we compare it to 65, which is again that default age, a male would be collecting about $575,000 over the course of their lifetime if they initiated at age 65, and a female, where are we at? About 625,000, according to that calculation. Continuing to defer your CPP to age 70, at the end of this graph, the far right-hand side, you'll see that the trend continued to increase. A male, over the course of their lifetime, initiating their CPP at age 70, might collect about $640,000, and a female might collect just about $700,000. So certainly this analysis supports the idea of deferring your CPP because you will collect more of it during your lifetime. But there's another interesting observation in the discrepancy between the lines. So the space between the blue line representing the male total lifetime collected CPP and the female in the orange line. If you see early on in life, if you collected at 60, there's not much of a gap here, but the gap seems to be increasing up to age 70 when there's quite a bit of a disparity here. And what that teaches us is that women benefit more from deferring their CPP due to their longer longevity and, of course, the compounding of the inflation adjustments. This brings with it a very important consideration that I'd like you to think about. If you've not been able to maximize your CPP contributions for some reason, you might want to defer collecting CPP in order to strengthen your position for life. For example, women who might have faced a wage gap, or anyone who might have come to Canada later in life or mid-career, let's say, and hasn't been able to accumulate a full CPP, which is typically based on 32 years of working in Canada, you might very well want to defer your CPP in order to build back some of the pension credits that you didn't collect early on. So I really would have you consider the merits of deferring your CPP. So again, thank you so much for what's a great question. Next question is related to university-aged students. My university-aged daughter has to pay tax this year. She's only received the Canada Emergency Student Benefit and Registered Education Savings Plan withdrawals. I thought RESP withdrawals were mostly tax-free. What have I done wrong? Is there a strategy to withdrawing from an RESP? So this is a super question because unfortunately RESPs, although they're incredibly generous, are also incredibly complex, and they're full of acronyms and rules. So I'm really going to try my hardest to make it as easy to digest as possible. The most important thing for a parent to keep in mind when planning their RESP withdrawals is that the financial institution keeps track not only of the value of the account, but also a breakdown of how much you contributed, how much the government contributed through the matching grants, and how much was actually produced as investment income when these two components were invested. This becomes important because when your child receives the withdrawal, you can specify how much of each of these three components is paid to them. Now, since the grants, the Canada Education Savings Grant and the investment income are both taxable components, you might want to be strategic in how much of each of these pieces is paid to your child each year. To optimize the withdrawal, you're going to want to elect withdrawals that are either below the personal tax exemption, which, as you may know, is the threshold under which Canadians can earn without paying any income at all, or taxes at all rather, or you might want to stay within a particular tax bracket. So for a family RESP, there's also a couple of other things to be mindful of, including how much you're reserving for other children who are named on the plan. And then there's also thresholds of how much grant each child can receive. So the most important point I want to make here is that as you are trying to bleed the account, you will want to tap into the grants and investment income first. And part of that is because, again, those are the taxable components, so you can be strategic about those, but also because your own contributions can be paid out to you or returned to you tax-free later on. So there's a little bit of an inequity. If there were any funds left in the account, there's an inequity with respect to what portions would be taxable and actually penalized, to be honest, and what portions could be taken out with no tax consequence. So what I've done here is a couple of simulations. So let's look at the first one, which is an example excluding any part-time earnings earned by your adult child. So let's say, for example, tuition and other qualifying education expenses were, let's say, $15,000 in 2021. The personal tax exemption for this year, again, the limit of income that any individual can earn before any tax is paid, is $13,808 for 2021. Okay, so we want to keep these two figures in mind. Let's start by drawing out the grants. Now the grants, there is a maximum that each child can receive. And what I've done here, just for fun, to be honest, you don't have to do it this way, is I've elected to spread out the grant across a 4-year degree, okay? To ensure that this child would receive a little bit of the grant each year. The next component that we want to draw out is the investment income. And what I've done here is I've elected an amount of the investment income that would, when added to the grant, remain under the personal tax exemption. So in this case, if $1,800 is paid out in the Canada Education Savings Grant, and a further $12,008 is paid out in investment income, these two then total the personal exemption. But it's not enough. Your child needs $15,000 for tuition and other expenses. So of the contributions that you made into the account, you will want to withdraw $1,192 for a total of $15,000 paid to your child to cover tuition and other expenses. Now here's the wonderful thing about this strategy. If we continue to do this over the course of the 4 years, and all I've done is increase the costs for inflation, the child will effectively have received $70,000 out of an RESP and paid no tax whatsoever. Similarly, what if your child, let's say, has a part-time job or works in the summertime and earns about $2,500? That $2,500 will be added to their tax return. So let's say, for example, we have to accommodate for that money, but let's say you're a generous parent and you're going to let your child use that money for other purposes, not for tuition and other expenses. Let's call that beer money. We're going to want to adjust our calculation to accommodate their earnings, which will be taxable, but we still don't want them to pay tax at the end of the year. So what have we done? Same $15,000 in expenses, same $13,808 as the personal exemption, and then we've the same grant amount. Let's make some room for the part-time earnings by reducing the amount of investment income that we elect to take out this year. Okay, so instead of the $12,008 you might remember from the last slide, now we're going to ask the financial institution to pay us $9,508. Okay, now what do we have by way of money that can go towards taxable income? We have our $13,808 comprised of these three pieces, but we want to let the kids keep the $2,500. So we only have the grant and the investment income to go towards tuition, meaning that we want to increase the amount that we collect that is our contributions. We have then the grant, investment income, and contributions totaling $15,000. And what we see here essentially is that same $70,000 being extracted from the account over the 4 years tax-free, plus our child has earned $10,000 over those 4 years as well, also tax-free. So if you can manage to work this out with your financial institution or your financial planner, you can effect tremendous benefit and tremendous tax efficiency from your RESP. Next question. What percentage of your income would you say is needed for retirement to have a similar standard of living? Estimates seem to vary quite a lot. No kidding. This question is particularly important because I like anything that prompts us to think ahead in terms of the standard of living that we want to enjoy in retirement. The truth is, one size certainly does not fit all. If I can manage to escape the winter a little bit and go for walks with my dog, I will be completely content. I don't need a fancy vacation. I don't need a boat. I don't need any of that. But some people do strive for those things. So during the UPotential consultations, one of the things we talk about is, do you anticipate slowing down during retirement, maintaining your current standard of living during retirement, or are you actually dreaming larger, wanting to enhance your standard of living in retirement? And it's this answer that we need to have in order to determine how to um, account for costs of living going forward. Now, for those of you who anticipate slowing down, this might involve moving to a quieter community where costs of living might be lower. For you, 60 to 70% of pre-retirement expenses might be all you need. If you're hoping to live better, perhaps catching up on things that you didn't have time to do when you were working, like extensive traveling or expensive hobbies like golfing or dining out, then you might need to increase your standard of living or the costs based on your current lifestyle. There are also health considerations, such as those who might have a family history of serious but not life-threatening illness, like, for example, dementia, can be incredibly expensive from the perspective of the care that your loved one will need, and it can often go on for many, many years because it's not actually life-threatening. So we would want to make those decisions based on at least some understanding of a family history of longevity. Now, as a default, what I typically do is I assume that your costs of living in retirement are going to be roughly the same as they were during your working years, but they're probably going to be reallocated. So for example, you might replace the costs of a work wardrobe with additional travel or dining. Now, I also tend, as this is an interesting question that came up, actually was posed just 3 hours ago on the website, I tend to build in some extra costs of care needs at the end of life, typically in the ballpark of about $2,500 per spouse per year. So it's important to note that when you're trying to anticipate, your future, many people say, well, I'm going to live more simply. There are some real situations like assisted living and other concerns that might need to be addressed as well. Now, of course, there are some efficiencies. Hopefully your children will be launched. Hopefully your mortgage will be repaid. Hopefully you won't have the same obligation to save as you do during your working years because you will have planned for this. This is where, of course, working with someone like myself, a fee-for-service planner, can be particularly helpful because we can help you quantify and project your calculations into the future. So thank you, thank you. This is a terrific question. I'm glad it was posed. The next question that came up is one that came up in various forms, and it's along the theme that I like to call the bank of mom and dad. I would like to gift a large sum of money to my son to assist him in purchasing a home. Is there a way to, quote, protect my gift to him if he and his partner split up in the next 5 to 10 years? Do I need to prepare a written contract for an interest-free loan signed by both of them to protect this early inheritance for my son? Boy, is this a loaded question. So to answer it, we need to pull out a few important issues. So let's start with talking about gifting or transferring wealth to the next generation. In Canada, there is no gift tax. You're free to gift money to your children or grandchildren as you see fit, as long as if that money is invested, you pay any uncrystallized capital gains before you gift the money. And also you have to relinquish all control over the money as you gift it to them. The only rules that might need to be observed would prohibit things like gifting assets to a child at less than its market value. You couldn't, for example, gift a cottage to your child that's worth $500,000 and gift it to them at $100,000. And the reason for that has to do with the fact that it's probably a taxable asset, and you would have to pay taxes up to that $500 value first, $500,000 value first, but that's kind of a discussion for another day. Also, if the money is going to be invested by your child, then there's a couple of other considerations that we'll talk more about in a minute. And in particular, if the person you're gifting the money to is a minor, there's a lot of rules around investing in a minor's hands, and certain penalties. One particular called a kiddie tax. So a lot of rules trying to avoid the idea that you would be using a child with next to no earned income to reduce the taxes paid on investment income. So the issue with regards to gifting monies to somebody who would then invest them have to do with something called income attribution, meaning that the income produced by the portfolio could be attributed back to the gifter of the money, even if the money is actually, registered in the hands of someone else. This doesn't actually apply to cash gifted to adult children. But when it comes to a home, and in particular, one that's occupied by your child and his or her partner or spouse, that home is treated in a unique way under family law. In the case, were they to separate or divorce. What is called the matrimonial home is usually split regardless of who paid what portion of the down payment, unless there's some pre-existing agreement like a cohabitation agreement or a prenuptial agreement in place. In other words, if the matrimonial home is treated like differently from other assets, you have to be particularly careful, and that's what the question that was posed is dealing with. Now, don't get me wrong, I totally understand why parents want to help with the high costs of housing in large urban areas. But the question here has to do with, gifting money so that it could also be protected from future family law claims. In order to do this, you need to find a way to tether the money back to the family of origin, and this is done with what's called a prescribed rate loan. Now, before we get to what a prescribed rate loan is, let me just talk to you a little bit about the difference between loans and gifts. Unlike a gift, a loan creates an obligation on the part of the recipient that is legitimate both in the eyes of the Income Tax Act and in the eyes of family law. So for example, let's assume that Alice is Greg's mother and she has some wealth that she'd like to gift to Greg. Greg then invests the money. The investment income produced by his investments, the investment account that Greg creates, could be attributed back to Alice if someone believes that this was done because Greg is in a lower tax bracket. Okay, not that it will be attributed back, but in case of audit, there's no good paper trail that Greg earned the money and that the investments were made with his own money. So there is some vulnerability here. In the case of a loan, if Alice, Greg's mother, loans the money to Greg, Greg invests the money and pays interest to Alice every year, then the investment income is taxed in Greg's hands. Greg did not have to earn the money himself because there is a legitimate loan being serviced. And this is the way to legitimize a loan of this nature. Now, specifically, a prescribed rate loan is a loan between non-arm's length parties such as family members or anyone else for whom you might not demand, let's say, the market price if you were to sell them a good or service. Okay? The unique aspect of a prescribed rate loan is that the interest rate is set by the government and is in force for the duration of the loan. In other words, interest rates can go up and down, the prescribed rate does not change. And this is particularly interesting because, as you can imagine, with historic low interest rate environments like we're seeing right now, this has become an incredibly attractive strategy. The last time I checked, the prescribed rate was 1%. A 1% loan between either spouses or parents and adult children, that's not a difficult loan necessarily to service. So you can see how attractive this might be. Now, back to the matter at hand, with regards to a loan for the purchase of a matrimonial home, what the prescribed rate would do, and I would certainly recommend that you research this with your lawyer and accountant, is it provides that legitimate tether back of the gift to the family of origin in case the child's relationship breaks down. By the way, loans of this type can be forgiven in your will or can be considered an advance of your child's inheritance as long as those instructions are provided in your will. So again, I would suggest that you speak with your estate solicitor for more information about that. Now, just so you know, not everything qualifies as a prescribed rate loan. To ensure that the loan is, made legitimately and would stand up to any questioning by either the Canada Revenue Agency, if we're talking about investments, or family law, if we're talking about a matrimonial home, interest has to be charged at the prescribed rate and has to be paid to the lender by the end of January every year. And of course, the interest is taxable in the hands of the recipient, the lender. Okay, so those couple things are really important. Incidentally, by the way, another popular use for a prescribed rate loan is loans between spouses. Let's say spouses who have vastly different tax brackets. A loan of this nature allows the lower income spouse to report taxable investment income without attribution back to the higher income spouse. Now, another way to accomplish this same strategy without a loan would be for the higher income spouse to cover all the costs of living, allowing the lower income spouse to invest his or her after-tax income. Now, in the absence of a prescribed rate loan, and yes, I appreciate that many people may have unknowingly or knowingly have done this already, any income produced by the investment account could be attributed back to the higher income spouse in case of audit. This happens a lot because people believe that you can't see through a joint account, for example. But of course, if CRA asks for a paper trail, would you have the paper trail? In my opinion, given how low the prescribed rate loan rate is right now and how easy it would be to legitimize this arrangement, I can't imagine why anyone would not want to protect themselves in this way and simply paper the transaction with a proper loan. So this was a meaty question, and thank you very much for submitting it. This question comes along the theme of planning across generations again, but extends to a strategy dealing specifically with leveraging investments. In other words, borrowing to invest. The question posed was, my wife and I are both retired and we would like to buy a condo and have our 2 adult children live in it while they are going to university. My question is, should we buy the condo outright, finance 50%, or finance 25% since mortgage rates are so low? Any thoughts? Well, I have lots of thoughts. Let's unpack this a little bit. Firstly, you have my sympathies. As the parent of a university student studying in another city, I completely appreciate the appeal of wanting to purchase a home that your children would occupy. The benefits, of course, involve, saving on rental costs and the possibility, and I say that very carefully, the possibility, because it's not guaranteed, that this property could appreciate as an investment. The downside of purchasing a property to be lived in by your children is also to be considered. Firstly, if your children will only occupy it for 3 to 4 years, the normal course of a university career, then this is a really small window of opportunity for the property to appreciate. Given that a lot of university towns are finding very low occupancy rates right now due to the pandemic, and of course, this is affecting housing prices in these cities. Remember also that there are a lot of costs involved in selling a property, like realtor fees and legal fees, which could add up to 10% of the value of the property. So simply put, the property would have to appreciate by more than 10% over the course of your child's studies for you to even break even. Now, secondly, if the property does increase in value, there's a good chance that you as parents will have to pay capital gains taxes because the property is really unlikely to qualify as a principal residence for you. M- My guess, and I don't know you because this was just submitted on a website, but my guess is if you have the means to purchase an investment property, chances are you have other wealth, and any capital gains that would be crystallized on this property would likely be taxed at a fairly high rate. So, setting aside the issue related to whether the purchase of the property is a good investment or not, now let's look at how this household could structure the purchase a little bit more efficiently. As you may be aware, every household can designate one property as its principal residence. And that principal residence, despite a lot of talk about changing tax rules, which did not happen in yesterday's budget, thank goodness, um, right now the principal residence exemption is still there, meaning that one property per household is considered a non-taxable asset. This is incredibly important because property values have been the single most valuable method for building net worth for generations. So if it's unlikely that the parents are going to want to tamper with their own principal residence exemption for the family home, there's a good chance that the home that your children will occupy is going to be a taxable asset to the parents. What I would recommend is that you consider gifting or lending the money to the children who then purchase the home in their own names. This way, your adult children can claim the principal residence on the home that they occupy, making any capital gains non-taxable. The second issue involved in the question that was posed relates to whether the purchase of the property should be done in cash or purchased with the use of a mortgage because of the low interest rates. Now, certainly the low interest rates are very attractive. They can also be attractive because often, and again, I say this carefully, often money that is borrowed to make money can be the interest paid on that money that is borrowed can often be tax deductible. Now, this is true, if you're building a business or an investment portfolio or a rental property. Now, sorry about that. Oh, got ahead of myself there. I spoke to a few accountants about this because I wanted to make sure, and they pretty much unanimously said that from a tax perspective, borrowing money to purchase a home that's going to be occupied by a non-arm's length party, remember those attribution rules, and especially one who's unlikely to pay rent, is not going to stand up to the smell test for Canada Revenue Agency for the purpose of deducting the interest paid on the loan. What you could do, though, is you could purchase a condo large enough to rent to a third student alongside your two children. In that case, there could very well be an argument that a prorated amount of the interest expense could be tax deductible. Now, one last issue involved in borrowing money to make money is something I've said before. Personally, I don't have the stomach for leveraged investing. But of course, I appreciate that there are lots of people who do. So beyond my own bias, I would just ask you to underscore how important it is that the property needs to appreciate over the course of your child's learning by at least 10% to make up the costs of sale. So this could pose a lot of pressure on the real estate market in that university city before you come out ahead. So if you can justify the investment in that way, then I would certainly support you in the purchase. But otherwise, I would be very, very careful. So just a couple of other things before we get on with the end of this webinar. I just want to talk to you a little bit about what was a much anticipated federal budget tabled yesterday. The truth is, the budget is mostly a spending budget rather than a revenue generating budget. So what it did is it sends additional emergency benefits to those who need it most by way of extending the Canada Emergency Response Benefit and the caregiver benefit through to September. And the only revenue initiatives that I saw were related to a luxury tax, what they're calling a smokers and boaters tax. And it's one that's inflicted upon people who are purchasing sort of higher end items like cars and private aircrafts. I think the dollar amount was going to be exceeding $100,000 in cost, or boats costing in excess of $250,000. So this is a very targeted tax. And in terms of those who are smokers, there is also an increased tax of $4 per carton. For now, and this is really important, going back to something we talked about today, the principal residence exemption has stayed unaffected, thank goodness. But there is a small tax on what they're calling vacant or underutilized foreignly owned homes. So this would be homes that, let's say, were purchased speculatively rather, and are under foreign ownership and aren't occupied, or a very, very large home that's occupied by one person. So there is going to be a new 1% tax starting in 2022 in that category. Again, thank you so much to everyone who submitted their questions for today's webinar. And thank you everyone for joining in. I apologize if I couldn't address your question today. Of course, I'll be continuing to collect them for future webinars and look forward to your feedback and suggestions. Our next webinar is scheduled for May the 25th. That's immediately after the first long weekend of the spring summer, where we will be discussing financial spring cleaning. An invitation to sign up for that webinar will follow. So just in conclusion, thank you so much for your time and attention today. A recorded version of this webinar will be made available soon. And of course, if I can be of any service, please do not hesitate to contact me. It would be my pleasure to help in any way that I can. Stay safe and stay well, everyone.